Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend and our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, June 5th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. This week we were up 4.91% on the S&P 500 and closed at 3193.93. What we're looking at here is a 5-year weekly chart of the S&P 500 where each candlestick represents 1 week of trading. And what we can see here is this was a huge week in the S&P 500, up almost 5%. That is extremely unusual. And you can see here that we blew through this trend line that I had drawn over these peaks that we had seen in the market during 2018 and 2019, excluding this huge rally that we saw really from October of 19 through the peak of the market in February of this year, 2020. So excluding this, we had these peaks here that I thought might present a challenge, and the market is so strong right now with all of the stimulus that's been thrown at it, and with the news that's been coming out on the economy and the coronavirus being less bad than what a lot of people had thought, it allowed the market to have a tremendous week this week, and we cut right through that upper line. So we're not that far off of the all-time highs. Again, 3386.15 was the highest close we've seen in the S&P 500. That was back on February 19th. So we're less than 200 points away from that. We'll have to see if this market can continue to rally at this rate. But a week where we're up almost 5% on the S&P 500 is pretty unusual. And keep in mind that since 1970, the average annual return on the S&P 500 is about 10% a year. So I wouldn't expect this type of a return during too many weeks going forward. At some point, this market will have to slow down and consolidate these gains that we've seen. Next, let's take a look at a few of the sectors within the S&P 500 and what they did for the week. And what we can see here is that the energy sector was up 15.69% for this week, so really playing catch-up after being bludgeoned earlier this year. The financial sector was up 12.13% for the week, and we can see that the worst performing sector for the week was healthcare, still positive for the week, so every sector of the S&P 500 was positive. But the healthcare sector was up 0.21%, so it was the worst performing sector of the week. And the rally this week in stocks was so strong that it even pushed the triple Qs, the NASDAQ 100, to an all-time closing high, as we can see here over on the right where my cursor is moving. And for those of you who follow the DIA, the Dow Jones Industrial Average, the Dow 30, we can see that the DIA is now above its 40-week 200-day moving average and still a little ways from its all-time high, but again, had a huge week in the DIA, up 6.77%. And from a capitalization standpoint, mid-caps actually were the best performing capitalization for the week. You can see that the MDY, the mid-cap ETF that tracks the S&P 400 mid-cap index, was up 8.42% for the week, and the MDY closed above its 40-week or 200-day moving average for the first time since back in February. And now we're looking at the IWM, the ETF that tracks the Russell 2000 Small Cap Index, and we can see that it also had a big week for the week, up 8.11%. And the IWM also closed above its 40-week or 200-day moving average for the first time since back in February. So across the board, this was a huge week in the stock market. Weeks like this don't come around very often, so I would not expect us to see this type of market action next week. But with the massive amount of liquidity that's out there from the Fed and the fact that some of the news is coming in less bad than what was expected, both from the coronavirus as well as the economy. It did allow the market, all capitalizations and all sectors, to rally and rally pretty hard this past week. Now what we're looking at is a chart of 2018, and I have this annotated with the Simple Market Signals signals. So these are the weekly signals that come out and are published in the newsletter. And so what we can see here is the signals, the Simple Market signals are green, yellow, and red. So I'm just going to go through this very quickly. We're going to take a look at a couple of charts, but I want you to understand how these signals work and how they can help you. So first off, we have the green signal, and the green signal is the best risk-reward signal for equity investors. And what you're going to see here is that most all upward progress in the stock market is going to be made when the signal is green. And then we have the yellow signal. Now, the yellow signal indicates change, and generally what happens is after a green signal environment, then the signal will change to yellow, and if the sell-off gets bad enough, it'll change to red. Now, in this time frame here, we had both yellow and red signals. I just kind of clumped those together just to kind of give you an indication of what happens. It's very, very hard to make money in the stock market when the signal is either yellow or red, okay? So again, most all of your upward progress in the stock market is going to happen in the green signal environments. During a yellow signal, you're either going to be sideways to slightly down is kind of the realistic expectations, but oftentimes that yellow signal will be that transition signal between a green signal environment and a red signal environment. So in 2018, we went green, we were green here, and then the signal went yellow here, and then it turned red, and we'll take a look at that here in just a second. The red signal is your worst risk-reward signal for equity investors. And your worst downturns, including bear markets, happen during a red signal. And we'll take a look at this here in just a second. Now, let's focus on this time frame right here where the signal went yellow. And we're going to switch to a chart that's going to straddle from September of 2018 through March of 2019, because I want you to understand what happened here. So right here, we had this green period, and then the signal went yellow here. And so what we're going to do is go over here. So right here is where that signal went yellow, all right? And then a few days later, the signal went red right here, and that was in October of 2018, as you can see down here. And then we had some sideways choppy movement, and then a quick sell-off. We bottomed right here in the latter part of December, and then the market started to rally. Now, a couple of things to understand is the market will bottom during the red signal, okay? Because again, remember that simple market signals, the weekly signals, measure risk levels in the stock market. So green is your best risk-reward ratio for equity investors. Red is the worst risk-reward signal for equity investors. And a yellow signal indicates that there's change, that risk is rising, and sometimes that risk gets bad enough that that signal goes red, okay? But anyway, so we bottomed here. The market started to go up, and we can see here that the signal went back to green right here. During shorter red periods, oftentimes the red signal and the green signal come out at about the same price level, okay? And I'll show you here on another chart in just a minute that the longer the sell-off, the lower that green signal is relative to where the red signal came out, and that'll make sense here in just a second. But again, this is just based on market metrics and market internals and things that go into the model, and it's about risk levels, okay? So if you get one of these quick sell-offs that rebounds very quickly, your red signal and your green signal can be in a very similar place, okay? So just understand that simple market signals measures risk in the stock market, and as you can see here, these rally attempts, right, because this was red, right, we went red here, so you get these rally attempts that fail, and then it sells off hard, rebounds pretty quickly, and then the signal goes green here, all right? Now, we're going to pick up right here, so this, again, is that transition period right here, all right? So now we're going into 2019. This is calendar year 2019 in the S&P 500, again, daily charts. So this is that red period. The signal went green here. So you can see here when the market is green, this is the best risk-reward ratio for equity investors. And during the green periods, this is where most of your upward progress in the stock market is made. Let's move back and go back to 2007 through 2009, and now we're looking at weekly candles. And what I want you to understand is when the market goes into a prolonged bear market, what really happens here, okay? So now we're going back again. This is 2007. The signal, the weekly signal, when I back tested this, because remember, the model came together in 2017. I worked on this for 20 plus years to figure this out. Finally, all the components came together in 2017. So what we were looking at here, okay, what we're looking at here is actual data. These were the actual signals that the model generated in 2018 and going through 2018 to 2019 transition as we looked here, and then 2019. So this, however, is back testing. So the original red signal that came out during the bear market that started in 07 and ended at the beginning of 09 came out right here, all right? Again, around 1,500 on the S&P 500. And as you can see, we, sold off for a few months. We had this rally attempt that failed and then sold off hard again, bottomed, and the market started to rise, and this signal came out green here, all right? So this is what happens during longer sell-offs, during longer red periods. Your red signal and your green signal have a huge price differential. Just between here and here, the market was down about 40%. Now, if you lose 40%, guys, it takes 66% to get back to break even. All right, so just to get back to 1,500 after if you've got 875 left and you're trying to get back to 1,500, that is over a 66% gain that's going to be necessary to bring you back up to break even. All right, so this is where simple market signals can really, really help during all market phases. But if it can help you minimize your losses during downturns, regardless of whether it's a multi-year downturn that ends up being a super long bear market or a shorter downturn like this, if you can use the signals to help minimize your losses and maximize your gains, right, during the green periods, that is where this thing is really going to help you, okay? So the whole key here, and this is where most people get it wrong, is start with the stock market first. What is the overall market environment like? Whether you're trading the S&P 500 through, SPY or a mutual fund or whatever it is, or you're working in the Dow, or you're working in the triple Qs, or you're trading individual stocks or options, you need to get the stock market right first. What is the environment you're working in, okay? Are you in a green environment? Are you in a yellow environment? Are you in a red environment? Get the market environment right first, and then everything else becomes so much easier after that. Thank you for watching this video. Before you leave, don't forget to subscribe to this channel. Please give me a thumbs up on this video and check out some of my other videos. I have a lot of great educational videos on this channel. And if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market, and a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in this Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.